Hi everyone, now you can hear us. Thanks for joining the webinar. This is hosted by the GSMA Mobile for Development Utilities program. This is part of a three-part series. We had a part one which looked at foundations, and this is part two, and this will look at impact funds. And this session will last for about an hour. My name is Wade Owajori, and I will be moderating today's webinar. I'll be supported by my colleague Charu Chadha, who will be collecting questions from the audience. We're joined by two great speakers. We have Sean Moore from Acumen and Tat-Seng Chiam from the Globalization Funk. It's great to have you both with us. And we'll come back for an introduction of each of our speakers in a short while. Before that, I'd like to give an introduction into the GSMA M4D Utilities program, and then we'll hear from each of our speakers in turn, and they will give us insights on their investment approach, and we'll get the advice they have for entrepreneurs on best practice and what things to avoid. We'll have time for Q&A. We'll take that at the end. And you can submit your questions at any stage via the chat box. At the end of the series, we'll be publishing the frequently asked questions on our website, and this webinar will be recorded and made available there as well. So I've got the housekeeping out of the way. Now for some few words about us. So the program is part of the Mobile for Development group at the GSMA. Our focus is on energy, water and sanitation services that leverage mobile to reach underserved communities in emerging markets, as illustrated by our mission statement. The program is supported by the UK government, and this support has been crucial to contributing towards the impact numbers that you see illustrated in the infographic. The case studies from completed pilots are an output from our commitment to knowledge sharing. We also convene the industry through workshops to share learnings and experiences. The feasibility studies, as you see listed there at the bottom, are examples of advisory services that we help to identify market opportunities for mobile operators in region. The number of grants awarded are a direct result of our innovation fund, which serves as a catalyst for innovation. And this investor webinar series is an example of our efforts to facilitate market building and encourage further investment. So that is a nice segue into why we're hosting this series. And just to call out that this is designed to help give entrepreneurs guidance on developing a better understanding of the types of investments, type of investors, and how best to engage investors when raising funds. So we've heard about foundations in the previous series. Now we're going to hear about impact funds. It's a great opportunity to bring in our first speaker, Sean Moore from Acumen, to kick off this discussion. Sean.
Great. Thanks, Wade. Hi, everyone. So I'm an associate director on the portfolio team in Acumen's New York office, focused on sourcing and executing new investment transactions, developing partnerships with co-investors and technical assistance providers for our portfolio team, and then also developing some new investment strategies and investment vehicles, specifically in the off-grid energy space. So happy to be here. So Acumen's mission is to change the way the world tackles poverty by investing in companies, leaders, and ideas. So we'll focus on the company side here today. Basically, Acumen invests long-term patient capital in early-stage, unproven business models that serve our target market, which is low-income populations in developing countries, and have the potential to scale over time, achieve financial viability, and really build some new markets and new systems for populations that traditionally have been left out of formal markets. So from a geographical perspective, we're in East Africa, West Africa, India, Pakistan, and Colombia, and Peru, and we actually just opened up a domestic operations in the United States. Can answer questions specifically on what countries, if anyone has those. In terms of sectors, we're currently focused on 4 sectors, so agriculture, education, energy, and healthcare. So overview of our investment mandate, we are kind of what we say venture stage. So this, to clarify, is we're typically post-pilot stage, meaning that the company has already introduced the product or service in the market in a pilot phase and is generating revenue. We very rarely do pre-revenue investments. So this type of stage be anywhere from kind of a Series A round or maybe slightly before that, perhaps, using a convertible debt instrument on a pre-Series A round to invest in a company. We have a long-term horizon of investment, 8 to 10 years, and can be leads around or co-invest with others. Typically, we like to see co-investment with when we invest. We've learned from our long history that having multiple capital providers at the table is essential to being able to help enterprises grow and scale and deal with some unforeseen challenges as they progress along their life cycle. So we're typically doing equity because these are very early stage businesses, but we do have flexibility to do some debt instruments when appropriate. We are typically looking at investments from $250,000 to $1 million for our first investment in a company, and can provide follow-on capital as we go forward in roughly the same amounts of the initial investment. So currently we have about 70 active portfolio companies. We've invested $15 to $20 million over the last couple of years in new companies, as well as to continue to support our existing companies. And you can see there we've invested in roughly 12 to 20 companies per year over the last couple of years, to give you a sense of the investment activity on a yearly basis. In terms of return expectations, this is obviously a very nuanced conversation, but effectively Acumen seeks to achieve a 1x return multiple on our overall portfolio. So on an individual deal basis, we're looking at returns, modeling out returns higher than that, but understanding that on a portfolio basis we're going to have a number of failures and a number of successes, and targeting a 1x return on the whole portfolio. And maybe just here I'll take a second just to mention, just so people know, Acumen is structured as a 501c3 nonprofit organization. So our model is we take in philanthropic contributions from donors, but then we invest equity and/or debt in for-profit enterprises, and any investment returns we make from our investments get recycled back into the nonprofit that we can then use for further investing and other programmatic activities. So in terms of pipeline, Acumen has fully staffed offices in each of the regions in which we operate, and so our teams are on the ground, immersed in local networks and the local markets and culture to understand where pipeline opportunities are coming from. So some of it is just leveraging those professional networks and being in touch with professional colleagues, and then obviously we are looking at sources such as business plan competitions, incubators and accelerators, business schools, and of course inbound submissions. In terms of what we look for, first and foremost, we can kind of tick off the boxes of fit with our geographic and sector focuses, then focus on Acumen's target market, and so maybe I'll take a second here to specify that. So in terms of our core target market, we typically look at investments that are impacting communities or people that are living on roughly $2.50 to $4 a day, as defined by the World Bank metrics, with purchasing power adjustment on those numbers. So basically, that's how we've kind of defined our core market of the bottom of the pyramid in that income segment. Not every customer of our enterprises will be in that segment. We understand that customers will be above that segment as well, but we are looking for companies that are including this segment in their strategy and in their mission to serve low-income populations. And then the third part is just the stage of the enterprise and capital required. So we talked about the stage of enterprise. In terms of capital required, for example, if we're putting in somewhere between $500,000 and $1 million, the company should be raising probably a couple $1 million or less in the round. If a large company or a large project comes to us needing $40, $50 million of investment capital, that won't be a fit for us. Next. So here's an overview of the investment process. Obviously a lot of information on the slide. Just the high level, you can see that it's roughly a 6 month process, kind of 4 to 6 months, depending on how prepared the entrepreneur is in terms of due diligence information they have on hand, and whether or not they've been through a diligence process before. Effectively, the summary overview is that we have a portfolio manager that will be leading the deal and taking the deal through our internal processes and leading the diligence process. We have a weekly meeting internally to talk about deals as they come through the process, all leading up to a monthly investment committee call meeting where investment decisions are made. And so there'll be a couple iterations of the portfolio manager and his or her team taking the deal to our weekly meetings to provide updates on diligence and get guidance on any key risks as we go through a deal, and then that ultimately will be presented to the investment committee where the decision is made, and then we'll finally affect the transaction through legal documentation and disbursement. So in terms of some red flags of why a deal might not materialize, the first point, so the deal team doesn't believe in potential for financial viability of the enterprise. And so, financial viability is a little bit of a vague term. It can be defined in a lot of different ways. I think here the point is that, when the deal team looks at an investment, certainly we're focused on what the social impact is, but also understanding what the long-term financial viability of the enterprise is. So that encompasses a number of factors, looking at the competitive environment, looking at the pricing of the product or service, and the ability to pay of our target market, again, as we've defined. So really understanding, can our target market afford this, or if not currently today, what would have to be the price reductions in that product or service to make it affordable for our target market. And then looking at things, kind of the basic calculation of how many products or services would need to be sold over the next, whatever the term is, 5, 6, 7 years to make, and at what price to make this enterprise viable given the projected cost structure. And so in some cases we see things that have tremendous impact, but just by nature of the relative economics of what we view as the cost of the cost base of the enterprise, and then the number of products or services that need to be sold, and the price that's being that it would have to be sold at to reach our target market, it just doesn't make sense. And so those are kind of some of the factors we look at in terms of assessing financial viability. The second and third ones, sometimes we can't just get to an agreement on investment terms. So typically this is around valuation. Obviously there's a tension where the entrepreneur wants the highest valuation he can get and the investor wants a lower valuation, and there's a negotiation. And so sometimes that spread is just too big to get to, and we both can go on our separate ways. And then lastly, sometimes this is kind of a double-edged sword. Either the company receives capital from other investors, so they do a deal with somebody else while we're in the diligence process, or we might say, okay, we want to do this deal, but we understand you're going to need more capital than Acumen can provide, and then therefore, we won't be willing to do the deal unless we get other co-investors on board, and maybe sometimes that doesn't materialize, and so we don't move forward with the deal. Moving on to kind of some of the quick advice topics. So this kind of phrase, don't try to boil the ocean, meaning, don't kind of try to do everything under the sun, or the fact that there's 1 billion people without access to electricity and another billion with unreliable access to electricity. Those are obviously huge numbers and huge markets around the globe, but saying that your enterprise is going to really capture a significant portion of that in the next few years is not as realistic in some cases. So I think it's balancing the grand vision for what the enterprise is, and certainly we want big thinkers and big visions to invest in, but we also have learned that a number of entrepreneurs or enterprises have struggled because they've tried to do multiple countries at one time, or they've tried to just go and capture these big markets without actually getting the unit economics of their product and service right first, or without getting the operations down first in one country even before they go to another country. So it's kind of that balance of saying, here's our grand vision, it's a huge market, and here's what we're going to focus on in the first 12 to 18 months with your investment capital to really prove things out. Secondly, any entrepreneur that, if you're raising capital already, you know this, but raising capital is a very arduous process, and I would just say will generally take longer than expected. So be understanding of that. And then third, don't be afraid to pivot. You know, the initial business plan, especially very early stage businesses that are either in the kind of, you know, just idea generation stage or even in pilots. Most great companies and businesses have pivoted either their business model or their core value proposition as they've scaled. And so, you know, I think part of the market-based approach to this impact work that we do is using the market as a feedback system to be able to test product and services and then innovate and pivot where need be when information comes back that might show a different path towards success.
Thanks very much for that, Sean. Thanks for these insights and those tips right there at the end in terms of avoiding some of those common mistakes. So we want to bring you back in again during the Q&A. Just a reminder to all the attendees on the line to continue to submit your questions via the chat box. And as you do that, I'd like to bring in our second speaker, Tat-Seng.
Great, thank you, Walter. Hi, everyone. My name is Tat-Seng. I'm an investment director here at the Global Innovation Fund. My responsibilities span everything from deal sourcing through to due diligence and then portfolio management for companies that we approve investments in. GIF, at least in its first few years, is designed to be a somewhat broad fund when it comes to sectors, and so I think you see that reflected in my portfolio, which spans a mix of energy access, food security, as well as domestic resource mobilization. So let me tell you a bit about the Global Innovation Fund. We were launched at the end of 2014, funded by a consortium of international donors like GIFID and USAID, as well as Silicon Valley impact investors such as Omidyar Network. Our goal is to invest in social innovations that improve the lives and opportunities of those living on less than $5 a day. And we're designed to be deliberately flexible in how we can go about this, both in terms of having no formally specified sectors or geographies, as well as being able to deploy a wide range of investments. I would say that one way in which we're really trying to bring our presence into the market is through a hopefully thoughtful combination of a willingness to take early stage risks, but also a real rigor and focus on making sure that evidence of social impact is clearly well understood and documented. GIF thinks about its investments as falling into three different stages: what we call pilots, what we call test and transition, and what we call scale. These correspond both to the amount of money that we're able to provide, but also our expectations about the relative stage of development that an organization might be in. As mentioned, we're a relatively new fund, but to date, we, by the end of this year, should be on track to have a portfolio of about just over under 30 deals. In terms of the timeline for exit, I think this very much varies depending on the type of instrument that we're choosing to deploy, as does the financial return expectation. When it comes to grants, which we tend to give only to nonprofits, there is, of course, no real financial return expectation, but also enables us to be a much more patient investor. Similarly, for equity and debt, we do try to, when possible, be a patient investor, but when using those instruments, we of course have financial rates of return, which might vary depending not only on the sector and geography mix, but also the relative stage of financing that we're providing. If we think about how we go about scouting deals, I would say that there are two main methods that someone can apply to GIF via. The first is our rolling application window, which you can find on our website. Every month we receive about 300 applications. We take a couple of days each month to review these applications that come through our open window. and typically progress somewhere between 5 to 7% through to further diligence of some kind. Increasingly, though, we all also are starting to build up networks of organizations that we trust and who are able to provide referrals. These are sometimes specific accelerators, incubators, or investors on the ground in countries that we're interested in, but also through broader convening organizations like GSMA or IntelliCap/SAMCOP, who have cross-geographical networks and deep sectoral or technical expertise. When we think about the main things that we look for before initiating discussion, we really think about the 4 criteria that you see on this slide. The first is around innovation and impact, the extent to which something is benefiting those living on less than $5 a day, and it's also competitive relative to the market. The second is the potential to scale to reach millions of people. The third is measuring success, evidence, either prior existing evidence or an intention to generate very rigorous evidence of social impact. And when GIF thinks about what it means to have rigorous evidence, we often define it in terms of, is there a relevant counterfactual that the intervention is being compared against? AKA, in a world in which the intervention did not happen, what is the relative impact gain? And there are multiple ways that an investee can go about this. Sometimes it's through a randomized control trial. Sometimes it might be via a more sophisticated form of A/B testing. And then finally, we also, of course, think about the team, and we want to make sure that they have the relevant expertise and capabilities to really drive work for the plan. Our investment process broadly resembles many other impact funds processes. When Sean was talking about the process at Acumen, I think in many ways it has a lot of similarities to GIF, where there'll be a deal team that's driving something, but also engaging with other internal stakeholders like an investment committee through multiple regular meetings. I would say that one way in which GIF is different is that because we are quite a diverse fund when it comes to the sectors and geographies that we're able to cover, we also want to make sure that we really are able to bring in deep subject matter expertise. And so I think we find this reflected in 2 different ways. The first is that very early on in the process, we commission external reviews from technical experts who have domain expertise, and will then often use the comments provided by the reviewers to really drive the diligence and questions that we'll pose to prospective investees. Secondly, when it comes to what we call our decision panel, which provides the ultimate yes-no decision on whether to proceed to contracting, at that point we will often also include external representatives who have given geographical and or sectoral expertise for the investee that is being considered. And finally, when it comes to the main reasons why deals might not materialize and how to mitigate those, in many ways the things that I list are very much tied to our investment criteria. Based off my experience of reviewing proposals, I would say that the 3 things that applicants often fail to do are, 1, being very clear about the competitive landscape for an innovation. For example, when it comes to something like mobile health, there are often dozens, if not hundreds, of different pilots being trialed, and it's not always clear that an applicant is clearly able to articulate how different or compelling they are relative to all of the innovations that have been piloted before them. I think the second is also being very clear on the overall long-term vision of success. I think almost any successful organization will have to go through multiple pivots on the path to really getting to scale. But having some kind of baseline plan, which you continually evaluate, pressure test, and refresh as needed, which you set up right from the start when you think about how do you design your organization such that at scale you know what your fundraising strategy will be and you know what the vision is of how you want to implement, is, I think, something that's a useful thought exercise to be thinking about, even very early on in your company's formation. And I think finally, to the point about GIF being a funder that cares a lot about evidence, when possible, citing studies or examples in the real world that show that there is an existing evidence base that your intervention is actually creating meaningful social impact, or that you will be the one to design some kind of study to generate that evidence, is something that GIF does find very compelling.
Thanks very much, Tat-Seng. I think that ushers us quite nicely into our Q&A segment, and I'd like to bring Sean back in as well for the first two questions, which I'd like to direct to both of you. But before that, just a reminder to everyone who's on the line that you can submit your questions via the chat box, and we have ample time to take these questions. So the first question I'd like to direct to you both is, in comparison to other types of investments, what would you say were the key things that differentiate impact funds from those other type of investments? And maybe I could ask Sean maybe to kick us off.
Hey, Wade, thanks for that. Sorry, could you just repeat the question? I just cut out for a second.
Sure. The question is how would you differentiate, or how would you summarize the differences between impact funds compared to other types of investments? Maybe some key differences in your view.
An impact fund versus a more traditional fund?
Versus a more traditional fund, or versus investments made by foundations, for example. Yeah.
Gotcha. Yep. Great. Yeah. So you know, there's a whole capital spectrum from grants to impact capital to more traditional commercial capital out there, and lots of nuanced types in between. You know, I think from our perspective, from an impact perspective, you know, we are squarely balancing the notion of social impact with financial viability. And so when we approach and look at an investment opportunity, we're definitely analyzing both of those factors and seeing how they interplay with each other and seeing how they're related. And so from a grant-giving organization, typically there's less focus on the financial viability of the enterprise. Not always, but typically, and the grant is used to, you know, for a specific project or a specific expenditure purpose. It might be for R&D, or, you know, getting the business off the ground and running to show some proof points where investment capital can come in. So I think, you know, as you get to the impact investment capital stage, that entrepreneurs can be prepared and to talk about, you know, financial viability, how they're building their enterprise to get there, what are some of the core factors that need to be addressed in the early days to set the stage for kind of financial viability. And so really, you know, we're at that stage where we're typically some of the first institutional capital into the company, and we'll look to not only invest capital but also provide post-investment support to, one, help grow and scale the business and scale the impact, but also to help prepare the enterprise for further investment capital and more traditional commercial capital down the road. So we'll look to finance the company appropriately with, you know, equity in the early days for the most part, as opposed to debt, and then also start to build in some kind of governance mechanism so that the enterprise can, again, start to attract more following capital down the road. So I think that's how we're different than maybe traditional early-stage grant givers. And in terms of difference from commercial capital, you know, basically, you know, from a financial term, it comes down to we're willing to take a much skewed risk-reward return profile than traditional commercial capital is willing to take. So traditional commercial capital aren't necessarily looking at our enterprises because they don't see the kind of the profit potential yet, and there's a lot of risk in building these enterprises. But hopefully, if we can build them to more attractive states, you know, using our basic capital, that then commercial capital.
Yeah, thanks for that, Sean. Some really kind of points in there. I almost wonder if I could ask, I know you said quite a bit there, almost a follow-on question, just because there was a relatively similar question submitted between you. So you mentioned the balance. We're trying to find the balance between social impact versus financial viability, and I kind of wonder if you could kind of give a flavor of what the trade-off is between those. If in trying to find that balance, is where does the scale sit more on?
Sure.
Yeah.
Sure. Yeah, no, it's an interesting question. I mean, this is a, this is a question that is discussed throughout the sector on a continual basis because it's, there's no real right answer. There's a lot of gray. But for us, I would say that Acumen's differentiating characteristic in terms of social impact is our target market. And Tat-Seng at GIF has a similar definition. They're looking for under $5 a day, and we're basically in that same realm. I said $2.50 to $4 a day. But having that impact metric as a target market, I think, is a differentiator for people like Acumen and us. And so that, that then starts to limit the universe of investments you can make. So, someone, for example, that is doing impact investing in Africa, and then you see what they're doing, and it's, they're doing replacing diesel generators at, malls in Nairobi or upscale kind of tourist lodge, safari lodges. They're replacing diesel generators with micro solar grids. Like, yes, they are having impact and displacing CO2 emissions and saving money for those companies. And so certainly there's impact there, but that return profile is going to look a lot different than if you're distributing, trying to get clean water out to low-income populations or even low-cost solar lanterns. So it's, that's the first point I would say, is that the target market kind of is a big factor in determining potential for financial viability and how long it's going to take to get there, as well as what types of products or services and companies we can be investing in. So once once we've kind of found companies that we believe have a product or service that is affordable to our target market, then it's when we do the investment. And as you go forward in the investment, I think it's just we look for entrepreneurs that can understand the tension between impact and financial viability, that can assess the market conditions and be able to kind of balance those tensions. So if a new business opportunity comes up that is serving a client or a company or something that is maybe outside of the target market, I think the then conversation is around, okay, that could be a really beneficial thing for the company, for our investee, if that new contract or that new business generates revenue and profit that can help create financial viability for the company. But if there's a risk that that new client or contract is going to take up all the management's time and they're going to lose focus on our target market, then that necessarily wouldn't be a positive choice for us. Or if the company starts to move completely up market and take its focus off the target market for us, then that's obviously a problem too. So, there's a lot of nuance in how we think about this, and these different types of situations arise as we go forward. But again, for us, it's kind of balancing that target market exposure is the first point.
Thanks very much, Sean. I'd like to bring in Tat-Seng here and maybe take our next question, unless Tat-Seng, you wanted to add anything different. But the next question I wanted to pose, so go ahead, Tat-Seng.
No, I was just going to say that I think that I agree with a lot, definitely agree with a lot of what Sean says. I just wanted to make one additional point around balancing financial returns and social impact. So when GIF thinks about this trade-off, we're deliberately designed to be a social impact first fund. But having said that, I think that you see that financial viability plays a very important role when you think about potential to scale. And the relationship between the two is such that if a business is not going to be able to deliver strong financial returns over time, that impacts not just profitability and the returns to investors, but also impacts the actual effectiveness of the social impact that's generated, either because the depth of impact per person is reduced or because fewer customers are being reached. And so to that extent, I think financial returns do have to be reflected as an input into the decision-making process on the social impact side, even if a fund or a foundation is prioritizing social impact.
Thanks, Tat-Seng, and I'm going to stay with you for this next question. We've kind of asked this question before for our previous speakers, but it would be great to hear a view from you both in terms of what impact does mobile technology, whether it's the use of mobile money, machine-to-machine connectivity, what impact does that have in your investment decision or the process? Can you tell us a bit of the benefits that you see and also some of the risks that you see?
Sure. I think that the rise of mobile technology brings a lot of interesting opportunities for interventions that are very scalable at potentially quite low cost, because often mobile businesses do tend to be relatively asset light and less capital intensive than, for example, a chain of for-profit eye care hospitals. I think, for example, of one of our recent for-profit investees, a company called Aftermarkets, which is doing cash goods remittances in West Africa. And a lot of the ways that they're able to drive down costs are through integration of mobile and internet technologies versus more traditional forms of remittance transfer. Having said that, I do think that the potential risks that I sometimes view with mobiles, or even what I would call widget technologies in general, and I think we're starting to see that with the rise of people talking about Bitcoin and blockchain, is that technology is, in some situations, a necessary condition, but not a sufficient condition to actually scaling up and creating social impact. And I think what some applicants sometimes miss is that behavioral change is actually really hard. No matter whether you're delivering something by a community health worker, a last mile distribution agent, a mobile internet platform. In all of these cases, you still need to figure out how do you effect sustainable behavioral change. And often that actually does require offline strategies to complement the online technology.
Yeah.
Thank you. Go ahead, Sean.
Sorry. Yeah, no, that was great. Agree with all that Tat-Seng said. For us, I think certainly we're seeing a number of mobile-enabled technologies in the market, and we've invested in a number of them already. And so certainly in the off-grid energy space, companies that are using M-Pesa for mobile money in Kenya, as well as pay-as-you-go technology to allow basically a new form of consumer finance are big areas. We've also seen it outside the energy sector. We have an investment in Isoko, which is an agricultural platform to get market information to smallholder farmers, and also a company called Sproximal, which is in the healthcare space, which is using anti-counterfeiting technology on pharmaceuticals to prevent counterfeit drugs from entering the market. And so certainly there's a big opportunity there, and as Tat-Seng said, to use technology to reduce transaction costs. And he made a great point. It's exactly right. It's you need more than just the technology. There's a whole infrastructure and kind of human element that goes along with it to drive behavior change. So the only other thing I would add is what we're also seeing is interesting is where Acumen has been leveraging mobile technology on the impact side as well. And so there's a number of mobile survey providers, either through SMS text or voice, that is enabling us now to do, large, 100 people, 200 people customer surveys of customers of our clients, of our portfolio companies, and get, basically market information back from them on the benefits of the product or the challenges of the product or rationale for why they bought it or didn't buy it. And that is giving a lot of great insight into our companies so they can continue to serve their clients better and understand what the value proposition is. And so there's some interesting things going on that kind of impact side, which blends into the core offering of the company and value to the company in terms of helping them scale as well.
Thanks, Sean. I'm going to stay with you for this next question. The question here is, how do you decide to expand to a new geographic area? And if you could take that with also kind of determining sort of generally how you choose which regions to invest in.
Sure. Yeah, you know, there's no real science to it. So over the years, Acumen has scaled up to where we are geographically now. So just as a next level of detail, so I mentioned, so we're India, Pakistan, Colombia, Peru, and our office there is Bogota in Colombia. In West Africa, we're focused on Ghana and Nigeria, and our office is in Accra in Ghana. And then in East Africa, it's one of our larger operations. We have an office in Nairobi, Kenya, and we currently have an investment focus on Kenya, Rwanda, Uganda, Tanzania, and Ethiopia. And so that kind of, you know, those, the Kenyan office has been there since I think 2006 or so, and so has expanded into new countries as it's grown its operations there. West Africa is relatively newer. That was in 2011, 12 we formally launched that, and so it's just a focus on Ghana and Nigeria right now. In terms of how we've selected that, you know, I think it was over time it was a combination of a couple things in terms of how we select where we go into geography. So, you know, one, obviously we go to areas where there's a target market that you know, will benefit from products or services from our enterprises. Two, you know, we are explicitly not serving kind of, you know, the poorest of the poor or, you know, kind of refugee camps, although some of our products and services have made their way to them, but, you know, or places that lack, you know, basic kind of socio-political stability and infrastructure. So, you know, or where there's war or where there's post-conflict zones. We're doing some of that in Colombia, actually. But, you know, basically looking for a place that has a need but also has some of the basic kind of infrastructure that you can create enterprises and operate in some form of kind of a market system. And then also, you know, we are very much believers in having local support and local networks to help us do our work. And so when we look at a new country or new region, we would like there to be, you know, some people that are, you know, either business professionals or governments or other areas of professional networks that are supporting our work either monetarily and or through their advice, maybe serving on our local investment committees or our local boards or global boards. And so being able to kind of leverage those relationships as we move into a new geography are extremely important.
Yeah, thanks for that. I'd like to bring in Tat-Seng back in and shift to a different question. The question here we received is, if a business can grow at a steady pace, should they still raise funds? What should the trigger point be?
No, that's a great question. I mean, and I think I would say that, similar to Sean's point around that there's no real science around when necessarily expanding into a new location, there isn't necessarily a set of hard, fast and cut rules about when you should be thinking about fundraising. I mean, one natural question that can be helpful in thinking about the structuring of the timeline is figuring out the point at which you anticipate a big step change in terms of your financing needs. I think if you're able to grow organically, and if you especially want to retain prolonged management control, then something like equity might not be necessarily the immediate right best fit. But as you think about whether it's expanding to a new province in the same country, expanding to a new country altogether, at these critical points in time, figuring out if some kind of debt or equity instrument might be valuable is, I think, a conversation worth having. I would also say that the role of an investor is, of course, significantly comes from providing financial capital. But I would also say that there is a big role for a partner when it comes to the portfolio management and venture assistance capabilities that might extend beyond money, whether it's helping you to thought partner on strategy development, making introductions in your network to potential operational partners, figuring out other follow-on funders that could be connected to. I think these are a big set of value-add activities that are not always thought of immediately when it comes to the role of an investor. When I, for example, think about our recent investment in Simpa Networks, an off-grid company in India, one of the reasons why we decided to participate in that particular point in the capital raising journey was because we saw ourselves as playing a bridging role between earlier stage foundation money, often which came in the form of grant financing, through to eventually helping Simpa to access larger pools of private equity and institutional money. And so to that extent, what we think about when we think about a Simpa investment is who are the funders that we can potentially be introducing Simpa to as they think about their next 1 or 2 rounds of fundraising.
Thanks very much, Tat-Seng. I'm just looking at the time. I think we probably have time to maybe squeeze in 2 more questions. So this next question I'm going to throw back to Sean. Somewhat, kind of spoken about sort of looking at businesses that have a degree of risk and so on and so forth. This question says, how do you determine if an unproven model is a good bet that has the potential for sort of the first mover advantage, or whether the model is just too risky at the time?
Yeah, no, that's a great question. That's kind of the golden question as an early stage investor, is what you're trying to assess with all the work you do on diligence and meeting the entrepreneurs and understanding kind of what the potential of the new model is. And so, I think there's one interesting point on this is, I think from Acumen's perspective, in a lot of the companies that we've invested in, we've actually seen that there is not really a first mover advantage. There's more of a first mover kind of challenge, in the sense that if you're bringing new products and services, introducing them into a market or to markets that don't really exist, there's a lot of customer education that needs to happen, to Tat-Seng's point too about kind of creating behavior change. There's a lot of time and resources involved in creating awareness and in driving that kind of those first early adopters to take on the new product or service. And in some cases, we've seen that companies don't really have the resources to do it themselves, but would need to partner with, nonprofits that are raising awareness, or get grant capital to do it, or partner with the governments for kind of public awareness campaigns. And so one interesting point on that is, for someone with new ideas, sometimes being the first mover can be some advantage, but we've seen in our markets that it's sometimes it's a big challenge to create a market for the product and service. And then secondly, in terms of how we decide, again, it comes back to, it's a number of things that all come together. I think that's what I would say, is that looking at 3 to 4 key things, and then you create a story about, okay, this kind of makes sense and we're willing to take a bet on it. So I think first and foremost, it's the entrepreneur. In these early stage enterprises, it's going to be the entrepreneur and the management team that really navigate the complexities and risk of starting a new enterprise. And so we have several conversations with the entrepreneur to kind of understand vision and competency and values alignment. And then, after we kind of have that, I think it's about doing some of the financial diligence to understand, okay, the economics aren't going to be proven out now, and there's a lot of uncertainty around them, but doing some basic high-level kind of sense checks to say, okay, this makes sense in the realm of what could be financially viable if the product or service catches on. And so that's kind of a second core element to understanding the model. And then, I guess the third thing is, I don't think we necessarily talk about this as much, but I think there is some kind of gut element to investing that takes place where it's a little hard to say, why or why not something kind of feels right or doesn't, especially on these earlier stage investments. I think once you get the entrepreneur, once you've done some of the financial diligence, once you understand the market trends and product market fit, there is a little bit of a gut sense of, okay, yeah, I feel good about this. We've done our work. We have a good relationship with the entrepreneur, and we have kind of, co-investment around the table, that it all makes kind of sense to me, and all the pieces are there together. So that's kind of how we think about it.
Thanks, and I'd like to follow that on by maybe directing a somewhat related question to Tat-Seng, and kind of its applicability to WASH. So sort of we see in both water and sanitation, there's a view that mobile-enabled business models are quite nascent. Are they unproven? I mean, what is your kind of take on an approach to investments in the WASH space, and kind of like any kind of guidance that you can give for any of our listeners who are in that space?
Mm-hmm. I think when it comes to the WASH sector, one of the innovations that I see coalitions increasingly trying to experiment with is using various combinations of blended finance. And so when I'm talking about blended finance, I'm referring to the deployment of multiple capital instruments in the same fundraising sort of period. Sometimes that might be grants to support either impact evaluations or very early stage product development. Sometimes there'll be a form of debt, convertible debt, or even equity to the for-profit entity that's driving a lot of the innovation. But I think also one of the interesting dynamics of the WASH sector, as I'm sure many of your listeners will be aware of, is that the role of government and utilities is significant, even more so sometimes compared to other sectors. You're often operating in highly regulated environments where utilities are considered strategic assets by governments. Regulations might be constantly evolving. And so one of the things that we have been trying to encourage a lot of our potential applicants to consider is to really be able to articulate what is the exact relationship that you might have with a partner, whether it's a electricity distribution company or a water or sewage utility, being able to both articulate a very credible relationship and working arrangement, also understanding ways in which either that utility or government agency might be able to provide some form of match funding, or exploring whether there are possibilities of an investor investing in that corresponding entity as well to deliver capacity such as data systems that will allow for more effective cooperation. I think it's an interesting piece of the puzzle to explore. And I would say that the challenge of development often is that there are lots of individual agents who are trying to do good, but there's a lack of a coordinated, systematic approach that really allows for effective collaboration. And so to the extent that potential investees are thinking about those issues, or at the very least what their stakeholder engagement strategy is, I think that's something that can often be really helpful and often throws up interesting creative ideas for blended financing and other innovative financing mechanisms.
Thank you. There were kind of some real nuggets in there, particularly for those in the WASH space, stuff that you might have known, some stuff that might be very helpful for you to consider going forward, particularly in terms of that stakeholder strategy piece. I think that's all the time that we have for questions today. If for our attendees online, if there are any kind of other questions that you have, particularly for our speakers today, please do write to us. Our email address is there at the bottom of the screen, the top one that you see in the bottom right, and we'll follow that up. If you have any inquiries about our innovation fund, you can direct them to the email address in the bottom right corner. We don't have a call open right now, but there will be one in 2017. I do hope that you found this webinar insightful. We're very keen to hear your feedback, so please do write to us. The recording will be available on our website in the coming days, and you can also find other resources there. Tat-Seng mentioned about evidence-based, and there's quite a few case studies that you can find pointing to certain evidences of certain business models, so please do visit our website. Following this webinar, all attendees will receive a survey, so we just appreciate your responses to it. There is still one final part to the series to come. The next webinar will be on the 17th of November. We'll be discussing funding platforms, and registration is open, so please do register. And of course, lastly, my thanks to our speakers, both to Sean and to Tat-Seng. Thank you very much for all of your points here today. It's given us quite a bit to put as part of our summary to this series. And of course, to all of our attendees for attending today and taking the time to join us. Thanks very much, and do enjoy the rest of your day. Thanks.